This is the most prosperous economy the world's ever seen, and it's going to be a very prosperous economy for the next 100 years.
All right, that was J.P. Morgan Chase Chairman and CEO Jamie Dimon on 60 Minutes last night, striking an optimistic tone about the state of the U.S. economy. We're watching futures this morning. We are expecting a decline at the start of trading this morning, down 123 points. The S&P is down 12, and the Nasdaq down 38. Joining us right now is Oxbow Advisors Managing Partner Ted Oakley. Ted, it's good to see you. Thanks so much for being here.
Thanks, Maria.
Do you agree with Jamie Dimon's sentiment?
Well, not quite. I mean, if he looks at the GDP over the last 4 quarters, the way things are headed, it's not quite as robust as it has been in the past. But, you know, we've had a fairly subpar GDP the last 15 years. You want to look at it, but we have a hard time going out 1 year, much less 100.
So what does that tell you about where we are? Are you worried about a recession? Are you worried about the slowdown deepening?
We are in this respect. The numbers keep sliding a little bit every quarter. If you look at the underlying portions of what drives the economy, the consumer is what everybody falls back on, but the consumer can fall off at any time, and they are a big driver, don't get me wrong, but they're only one driver. You know, if you look at CapEx from corporations and various things, that's not working right now. So we've got our eye on it for sure. I'm not certain I'd call a quarter that would be a recession, but it's definitely slowing more than it was a year ago.
Ted, hi, James Freeman at the Journal. You mentioned CapEx sliding. Is that 100% about the China trade dispute, and does that turn around, or is there some other issue in the U.S. economy that's going to discourage corporate investment?
I think one of the things, James, is part of the problem is they have not been able to find organic growth they could develop internally. And you see them buy things and do things like that, a lot of financial engineering. But it's been a long time since we had a lot of companies that could really produce a tremendous amount of organic growth. And they've all flipped back in the last 10 years to using financial engineering to make their numbers go.
Hey, Ted, Art Hogan, I'm curious what you think about productivity. As we look at the productivity numbers over the last 6 months, it seems like that's working its way in the wrong direction. What do you think the drivers are there?
Well, it could be a number of things. I think what's happening with corporations is that they're cutting back ever so slightly in things that might make them more productive. And it starts with the fact that their margins are pushing down a little bit right now. And I think that's having a problem with them. And you can't see it and everywhere, but you sort of see it underneath.
Ted, good morning. It's Liz Peek. What do you think of the housing sector? I keep thinking with mortgage rates having come down that this sector of the economy, which has been sort of sluggish, could provide a little extra oomph over the next 6 months. What do you think?
Liz, you've got a point. And normally when you get a decline in interest rates, you really get a big push on housing. We haven't gotten as much this time. And I'm involved with a couple of banks as well. And one of the things we find is that the cost of the structure itself is having as much impact as maybe interest rates had 10 years ago. So the cost is keeping people out of that marketplace.
What about rates? I mean, yields climbed above shorter-term treasuries in recent weeks. Positive sign that investors are not expecting any pullback when it comes to growth and inflation. But when you look at where the 10-year is, and then there's a story in the Journal this morning, once snubbed investments joined the rally, talking about some of these areas that have not participated in the rally but now are, perhaps indicating that things are getting better and are expected to in 2020. Your thoughts on that with you know, combined with the low level of where rates are?
Well, I'll answer that question, Maria. About 15 months ago, I was on your show and expected rates to really come down a lot, which they did. Jamie Dimon, by the way, another point there, thought the rates would go to 5% on the 10-year. We totally disagreed with that. But I will say this. I think they backed up. It's a normal backup. You go 9 months in a move, and then you back it up for 60 to 90 days or so, and then you go again. We think it's a good entry point right now, again, for the Treasury. And we don't see the start of some, I think there's some, what you want to call, or what people want to call green shoots overseas. But in general, I don't think we're at a point where we're going to take off here for any reason.
I see. So have you changed your allocating of capital as a result of this? Do you pull back in U.S. equities? Do you find opportunities internationally, or you stick with fixed income?
Well, we run both, and I'll tell you, our fixed income is having the best year we've had in a long, long time, because we were really big in the long treasury, and we're also, this year, we took part of that off, but actually in the last week, we moved that allocation back up, and on the equity side, we like equities, and we just can't find the value we'd really like, so the cash levels are higher than normal.
Yeah, I see. Valuation, well, look, we're in record territory, so I get it. Ted, it's good to see you, sir. Thanks so much.